record to this computer. Alrighty, so I'm going to go ahead and get this meeting started at 12 o'clock on the dot. I think there's only a couple of us in here right now, which is perfectly fine. I'm sure more will join. So to kick this meeting off, I want to go over Fibonacci first, and then we'll dive into risk management. This isn't going to be a long workshop. I'd like to keep it at an hour maximum, just because I know people are at work and they are busy between work and school during the day. So I'm going to get to Fibonacci questions after I go over Fibonacci trading and a couple of the notes that I want to go over that I've written down. So the big thing with trading with Fibonacci is you need a trend in your favor. Okay, Fibonacci will not work if there is no trend present. Now, if we look at ES action over the last 4 or 5 sessions or so, and we're looking at it here on the 15-minute chart right now, what we're seeing is just a pretty much straight trend higher. Okay, so this will be a great trend to use one day for a long GP if we want to use this swing low that was seen on the 27th of October to whenever a swing high is put in place. And we will then anticipate a rollover to the downside, and we would have our Fibonacci levels marked where we would like to essentially buy the dip at a key level. However, I want to stress here, Fibonacci will not always work if you have a straight move higher. Okay, so if we look at the last 2 sessions now, especially today's action, which is November 2nd, Thursday, I really don't see any high probability swing low to swing high that I would use to draw a long golden pocket. And we're drawing the long golden pocket today because the market is trending higher. So we want to trade with the trend, right? Even though it's a reversal strategy, you're going to trade with the trend, which is up right now. I don't really see a high probability swing low to use. Okay, so we can use the Globex low a little bit, which came in at like 4262. However, that's not the low of day. The low of day was right at open, and pretty much price kept climbing higher all through Globex, especially once Europe opened. That's when price really started to take off. But other than this swing low, I mean, it's a decent low, but it's still not below Globex open, right? So I would say it's a poor swing low. It can definitely be used as a swing low, but I would just say it's a poor level, and it's not necessarily a high probability swing low. However, if we were to use this swing low, we would simply draw to high of day. That would be our swing high. That is the easiest swing high. And if you notice, price hasn't even touched the 23.6% fib yet. Okay, so again, a poor swing low. We're maybe seeing signs of distribution at the highs here around 43.20, but all in all, this is not clean action yet. Okay, I do not like this swing low, so I think it's kind of a poor low, as I said, and I really don't see any high probability setup to use Fibonacci right now. However, if we go and look at yesterday's action on FOMC day, I'm going to zoom in here. We have a pretty good swing low, in my opinion. Okay, so low of day came in pre-market about 7:45 on this 15-minute candle right here. Okay, so when we draw using this swing low, which is the Globex low, I guess you could say it's still Globex 7:45. Okay, notice it comes before, or excuse me, notice this low of day comes under Wednesday evening's open for Thursday's entire session. You know, futures open Wednesday evening at 6 p.m. Eastern. Okay, notice that this low comes under Wednesday evening's open for Thursday's session. To me, that is a better low. It's not a poor low like Thursday's was that I just went over. I like this low a lot more because it's a new low below the opening price. Okay, so we draw from this swing low here to high of day. Now, look what we see. We see a lot of action. Where is a drawing tool? There's the brush. Notice where buyers continuously defend. Okay, and ignore volume profile. I have the volume profile on my chart. It has nothing to do with what I'm talking about right now. Okay, we're strictly focusing on Fibonacci. Notice where buyers defend during FOMC. I just circled it. It is the 50% fib level. Okay, so a lot of people who trade with Fibonacci, they really only use 2 different Fibonacci levels. Okay, many people will just ignore all the other levels except these 2. It's the 50% fib level and the golden fib. Okay, the golden ratio is probably the most universally popular fib level, and I've talked about that I've talked about it at length. I've gone over the golden fib in my how did I word it? The Fibonacci workshop PDF and the like hour plus long video where I go over trading with Fibonacci and the golden pocket. I went over the golden fib a lot in that and those two resources. I'm not going to dive into it so much today, but this is a great example of buyers defending the 50% fib level between two major swing points. Okay. You have low of day, which is a very easy swing low to use. When you're drawing the long golden pocket, make it really easy on yourself. Use the low of day to get it started, especially if there's a nice dip overnight and then price reverses into the cash session or the cash session open. Excuse me, I'm getting tripped up on myself. The low of day overnight during Globex, that is a really easy swing low to use to your advantage. The swing high that you would use for drawing the long golden pocket, really simple, high of day. That's all you have to do. And when you draw the long golden pocket, it has to go from left to right. Okay, it has to go left to right. The short golden pocket will go from right, or excuse me, will also go from left to right, but the swing low needs to come before the swing high. I see some people get that mixed up a little bit. Um, um, Let me just admit here real quick. The thing was blocking my view. Okay, so I see some people will draw the swing low after the swing high a little bit, and that is not the proper way to do it. Like, let me give you an example. See, they will draw it something like this. Okay, so you have your swing high over here, and then you have your swing low to the right side of the swing high. That is not the correct way to draw the long golden pocket. The swing low always has to come first when drawing the long golden pocket, and you are drawing it left to right. You're still going to move your cursor left to right when drawing the swing high, but the swing high, or excuse me, when drawing the short golden pocket, but the swing high comes first, and then you draw to the swing low when you draw the short golden pocket. Okay, and I see some people get that confused, and that's not going to give you an accurate fib levels. Essentially, it's going to be very poor levels, and it may or may not work still. But if you're using the correct swing lows, you might have just drawn it backwards. I don't know, but if you can't draw it correctly, you have very poor levels, and that can lead to poor trades essentially because it's not a high probability setup at all. Okay. However, so if we compare the last 2 days, to reiterate, because I just saw we had someone new join, I like a swing low that comes during Globex. I think it's a lot better high probability swing low to use for the golden pocket versus one that comes during the cash session, if that makes sense. And if it comes before, or excuse me, if the swing low during Globex comes below, or I would say it hits below Globex, or excuse me, cash session open. If that makes sense. I'm definitely tripping myself up here. And I'm going to mute real quick on. Okay. So I want to show you two examples in oil that I used the last 2 days. So let me go ahead and delete one here so it cleans up the chart a little bit. All right. So ignore today's session for oil. Okay. So using intraday timeframes when we draw the long golden pocket, I really like focusing on swing lows. Now, what I've seen happen a lot lately, and I saw it more so the last couple weeks in ES, but I haven't seen it lately this week, obviously, because the market's been going higher the last few sessions. If we look at CL right here on the 15-minute time frame, we have a really nice swing low that came at close on Tuesday session. Okay, we see a nice 15-minute hammer. That is a high probability swing low right there. Price confirms it. Nice hammer. Okay, it comes at the low of day for this entire session on Tuesday. Oil rallies all overnight, or excuse me, overnight, and then we get a swing high put in place. We're using two different swing points on two different sessions. And this is, you can consider this to be a day trading time frame, if you will, because it's the 15-minute time frame. There are some people who like to take swings off the 15-minute to each their own. I personally do not, but I have seen it happen before. So I do consider the 15-minute time frame to be a day trading time frame. And in my opinion, to identify intraday trends for drawing like an intraday golden pocket, whether it's long or short, doesn't matter. I like using the 15-minute to identify those high probability trends. I just showed you one on ES. I'm going to show you two here on CL that I want to use as an example. Okay. So we get our swing low on Tuesday session. Swing high doesn't come in for many hours later on Wednesday session. Okay. We have our two swing points. All you have to do is draw from the swing low to the swing high. And remember, the swing low is always on the left. Okay. You cannot draw or you cannot start drawing a long golden pocket and begin at the swing high. That will be like, that's just wrong. I don't know how else to describe it. You're using essentially the swing points are just backwards. So you start at the swing low and then you draw to the swing high, moving your cursor left to right. Okay. Right here, we see price taps the golden fib. Now, if you have years of experience under your belt, you will essentially, and if you trade through your years of experience, and if you trade the same stocks over and over and over again, you will notice certain stocks have certain patterns that they love to repeat certain patterns. I used to trade Boeing a lot up until before 2022, and Boeing was infamous for forming descending wedges all the time. And if you go back and look at like 2020 through 2021, go on Boeing's daily chart, you will see a repetitive series of descending wedges that Boeing constantly formed and would eventually break out of to new swing highs. Boeing was infamous for like 2 years in a row of forming descending wedges. Okay, that was a theme that Boeing stock had created, and it was basically a pattern that it kept repeating over and over again. If you can identify those patterns in specific stocks, you can use that to your advantage. Okay. One pattern that I have noticed in my experience the last year or so of trading oil is oil loves to respect the golden fib on dominant trends. Okay. That is another pattern that I've noticed. Okay. I used Boeing as an example. But oil, from a technical point of view, I've noticed oil loves to respect the golden fib. It seems like there's a lot of action, there's a lot of algorithms or a lot of traders who trade oil are very attuned to the golden fib. Now, here's the thing with Fibonacci trading, and I'm not sure I hit this enough in my PDF in the workshop video that I did a couple months ago. Fibonacci trading is all subjective, and I'm actually going to answer one of the questions that was asked in the survey that I did last night. So somebody asked, Thinkorswim, is there auto fibs for Thinkorswim? To my knowledge, there is not. I don't use Thinkorswim's charting tool anymore. I use it for execution, obviously, because I trade through TD Ameritrade for options. But for those of you who have been with me for a really long time, you remember I used to use Thinkorswim, then I made the permanent transition to TradingView, and I'm honestly not going to go back. I think TradingView is a lot better than Thinkorswim, in my opinion. But they asked, does Thinkorswim have auto fibs? And in my opinion, or excuse me, as far as I know, I don't think so. Okay, now TradingView does have auto fibs, and I don't. TradingView the last year or so, I think has started to really crunch the numbers, and they're starting to make people pay for things that used to be free a few years ago. So I don't know if they still offer on their free plan or whatever, if they still let you use like 3 free indicators, I think it was on a chart, is what it used to be. It was like 3 or 6 or something. And then if you used like more than the free amount, then you had to upgrade to a paid plan or whatever. I'm not sure if they still let you use indicators for free on their like free plan and whatnot, but TradingView does offer auto fibs. There we go. Yes, Thomas says it in the chat. Yeah, so Thinkorswim does not offer auto fibs. TradingView does the last time, and I actually used to use them. And now here's the thing. I gravitated away from auto fibs, and I want to make this very clear about Fibonacci. Fibonacci trading is subjective to the individual. It is up to you to identify the swing low and the swing high that you want to use. It's really easy to use dominant time frames like the daily time frame or the weekly or monthly to find high probability swing lows and swing highs. Okay. If you were to draw the long golden pocket on SPX from the very low of the COVID crash in like, what was it, March or mid-March of 2020 to all-time highs at like 4,800 in November of 2021. I think I've got my dates right there. Draw the long going pocket from the bottom of the COVID crash to all-time high around 4,800 on SPX. You will notice the 50% fib level is where the bear market ended on SPX. Okay, but in that massive long golden pocket, you are using two very large swing points to draw that golden pocket. Okay, it's not a coincidence that the bear market ends at the 50% fib level. Okay, because many people used those two swing points, COVID crash lows, all-time high. They drew their Fibonacci out, and remember what I said in the beginning: the 50% fib level and the golden fib are the two most popular fib levels that traders use, and many times they will ignore every other fib level. Okay, it's not a coincidence the bear market ended at the 50% fib level for SPX. Okay, it's not a coincidence at all. Many traders who can move the market, I want to add. I'm not talking about retail traders like ourselves. I'm talking about Wall Street and hedge funds use those two swing pivots, and they had that 50% fib level marked. It's not a coincidence. That's where the bear market ended, using the long golden pocket there. Okay, so that's a really big example. So back to what I was saying, Fibonacci levels and these swing points, the swing high and the swing low that you use, it's subjective to the individual. The more you trade with Fibonacci, the more you will figure out what swing levels are high probability versus low probability. Okay, and that's another question that I received regarding fibs that I want to answer. So the question was, what is the win or success rate with fibs? And I would say it's more than 50%, but again, it's subjective because it depends on what swing points you're going to use. Okay, and there's many different variables I can use for this. Okay, if I'm going to use futures trading for an example, and I'm going to measure my success rate, well, it's going to be limit orders every single time. There can be an instance where I can be stopped out. Let me move the chat lower. Here we go. I can be stopped out on like a 20 tick loss off the golden fib, but price reverses inside the long golden pocket. Okay, so see this golden fib or this golden pocket here for CL. Okay, I can take a 20-point loss right here, 20-cent loss, and then price still reverses inside the golden pocket at the 70.7% fib, and say price breaks out higher. Okay, so I took a loss on the trade because I longed the golden fib, but if CL reverses at the next fib level lower, not invalidating the golden pocket, is it still a valid setup? And I think yes, it's just I was stopped out. Okay, so again, as far as win or success rate with fibs, I don't think that's the best way to ask it. I'm not saying the question's wrong by any means, because I completely understand why you would ask that, but I just don't think it's the best way to look at trading with Fibonacci, if that makes sense, because it's all subjective to the individual. Okay, you might think that this swing low and this swing high that I have marked don't make any sense, and that's perfectly fine. That's up to you. That's why I said dominant time frames make it a hell of a lot easier for you to identify these key swing points. And then I used like the biggest example that I can think of: COVID crash low to all-time high, draw the massive golden pocket, 50% fib level, and SPX is where the bear market ends. Okay, that's why I used a very easy example to walk you through that. Okay, so looking at oil here, as we get back into it, not a surprise, oil bounces at the golden fib. Now, how big of a bounce is this? Okay, so it rallies for 60 cents. Okay, this is going to lead a little bit into risk management here as I shuffle around my notes. This right here, say you got filled right here at the low and you sold right here at the high. Okay, that's a $600 win with one lot on CL. Okay, that's $600 profit. Okay, you might look at 60 cents and say, well, that's not a lot. It's only 60 cents. Well, that's $600 each. Every cent in oil is $10 profit or loss. Okay, so $600 is a nice chunk of change there. Okay, so we see the sharp reversal, but of course, CL trades lower. Okay, it is eventually the golden fib breaks and whatnot, blah, blah, blah. We also see buyers defend the 78.6% fib level for a decent bounce of like 400 profit or whatever, like 40 pips. I think 40 pips is what CL traders will say, and I'm not familiar with that because I think pips is forex language if I'm not mistaken, but I don't trade forex. So this is all from the matter of a trade. Okay, you don't want to get trapped in a trade, especially one that goes for 600 bucks. Okay, obviously this golden pocket ends up failing. Okay, if you held this and never sold for profit after seeing $600 profit come your way, you would have been stopped out eventually. Okay, say you put your stop loss below the golden pocket, you're eating a let me admit someone. You're eating a $500 loss if you don't sell for profit up here. Okay. Now, if you use Fibonacci and specifically the golden pocket in a perfect world, and I want to emphasize that in a perfect world, when you price comes into the golden pocket, it makes a full retracement higher. Okay. That is not always going to happen, as this example in CL demonstrates right here. Okay. It rallies for a decent bit. It's almost a 1% rally. Okay, this is a nice move higher that you can capitalize on, but eventually it fails. So that's where managing risk comes into play. Okay, if you have a winning position of $400, $500, $600, what are you doing not raising stops? Why are you letting such a massive winning trade turn red on you? Why are you going to let a $500 winner turn into a $500 loser if you put your stops below this golden pocket? Okay, that's inexcusable in my opinion. You should not let a big winner for $400, $500, $600 turn into a loss. Okay, and now I'm speaking in futures languages there. Okay, if you options is a different ballgame a little bit because you can load up with 10, 20 contracts. $500 might not be a lot of money at all based on your account size, blah, blah, blah. From one lot perspective, if you hit $400, $500, $600 profit, raise that stop loss because you never know what can happen next. Okay. If this trader does not raise their stop loss right here, they end up getting stopped out because they were being greedy essentially and did not listen to what the market was telling them in the now moment. For example, reversing with volume. Okay. We see this bearish candle right here. We see the increase in volume, not to mention this rally comes on low volume. So it's already sus to begin with. No wonder it ends up reversing lower and then you're stopped out. Okay. So the greedy trader expects, and I want to use that word, I want to emphasize that word as well. The greedy trader is expecting the market to make a full retracement higher. Well, that's not going to be the case always at all. Okay. That's why you have to constantly manage your risk, raise those stop losses, and adjust to the new information the market is generating in real time. Okay. Even if you longed this golden fib right here, and you sell when this 5-minute candle closes right here, this 5-minute candle, because we see it comes with an increase in volume, that is the perfect time to exit a trade for over $300 profit. Okay. And again, this is all hypothetical. Okay. But you need to be able to constantly readjust and adapt with the market in real time as new information is generated. Okay. To begin with, this rally off the golden fib, it's sus to begin with. Why? Because it's low volume. Look at the two green candles. It comes with low volume. Okay. I think it's honestly pretty surprising that CL was able to rally almost 1% off the golden fib on low volume. Okay. So now I want to delete this setup here and I want to use a different one. Now, remember what I said when I went over ES. And if you missed my beginning part, one thing that I said was when I use a swing low to draw the long golden pocket, I like the swing low. And this is intraday trading only. This is not swing trading at all. This is strictly from a day trading perspective. I like the swing low to come below the session's opening price on the day prior's evening. Okay. So for example, this swing low in CL comes below the opening price Wednesday evening. Okay. So it looks like the opening was like 80.82. The swing low comes at 80.22. Okay. So we get a nice lower low. This is a really nice swing low to use. So once we get that swing low in place, we just wait for price to confirm a new swing high. Okay. Look at this strong upper wick on this open or on this 15-minute candle. It's not open. It's already closed. That was my bad. And then we see this strong move lower. Okay. When this 15-minute candle closes, that's when we know, hey, the swing high is in. Now we can draw our golden pocket. I'm sure you've seen me over the last couple of weeks trying to draw a long or short golden pocket on ES, and I will essentially do it too early many times because price didn't reverse that much, and then we end up getting a new swing high or a new swing low, and then it completely invalidates the fib levels that I had drawn. Okay, so once we get this high probability confirmation that the low is in and then the high, we let price come to us for our entry. Okay, so I just showed you CL yesterday respecting the golden fib. Here we are yet again with CL respecting the golden fib. Okay, I'm telling you guys, if you trade oil, and this is more so for my futures traders that follow me, if you trade oil, the golden fib will be your best friend. Oil respects the hell out of it. Now, obviously, not every time with the golden pocket is it going to result in a winning trade, but 2 days in a row, CL has respected the golden fib, and it's rallied really, really nicely. Now, I took CL longs actually on this candle right here for a nice win earlier today. I would not have taken this golden pocket entry again the second and third time because buyers defending this level have already been tested more than or once, right? So here's the first test. That's the valid trade in my opinion. The second test, okay, I'd say it's 50-50. Accept your risk and don't be surprised if you get stopped out on the second test. On the third test of the golden fib, absolutely not. I'm not taking that trade just because it's not high probability in my opinion. Okay, this is really no different than a zone being tested more than once or a key level. If you trade with support and resistance levels, in my opinion, price testing a fib level 2, 3, 4 times, it's no different than a zone or a key level that you have charted being tested, and the level gets weaker and weaker and weaker each time. Okay, there's no way I'm taking an entry on a fib level on a third or fourth test. Okay, however, to hit home on my point here, CL respects the golden fib, and look at that, it leads to a new high of day, and price actually exceeds or the swing high. Okay, so this worked out really, really well. Obviously, it took a bumpy path to get there. Okay, now if you want to make this a high probability setup, because this is what I saw earlier when I took this trade. So we see price comes into this golden fib right here, and I want to mark this wick specifically because this is the one I traded. Okay, so we see that this is prior support. We know buyers were active at this area before, but then we get this sharp impulse move lower, and it comes at 9 o'clock. So I wonder if there was news specifically for oil. I'm not sure if there was or not, because I'm not a news-based trader, especially for oil, so I don't pay attention to it. But maybe there was news at one point right here, and that's what caused that brief sharp move lower. Look at the volume profile. Okay, notice how there's a drop off right here in value. There's no value right here. This is essentially going to act as a magnet for price to fill. So we draw our long golden pocket right here. Price comes into the golden fib. Okay, we know buyers were active here before. My thought process behind this long trade was, price is coming into technical support. We're at the bottom of the value area. Buyers want to defend this area, okay? Because if they don't, CL is going to revisit these swing lows and probably lower. Okay, that's probably what's going to happen if this golden pocket fails. Okay, and it's not probably, it's a very high probability because look at our value area here. There's no value here. There's no support for buyers to use. Okay, so this is what I saw, and this is why it was a high probability trade in my opinion. And as it turned out, as the day has progressed so far, buyers have continued to defend this value area or the bottom of this value area. And now, of course, price broke out and reversed higher, completing a full retracement to the upside. Okay, so that is like a bullish confluence example for you, because the confluence comes from, remember, you want 2 parts. You need 2 things to create a confluence. So we have the golden pocket right here. That's one half. And then we have the value area right here. Buyers defending value. They don't want to give up and let price fill this volume gap lower. So that's the second part right here. And that's what creates the confluence, if that makes sense to you. Okay, I know it's getting a little off topic there, but I wanted to use like a real past trade example for you. Okay, so let's go ahead and revisit. ES right now. And now I want to go over some risk management notes that I have. Okay, and I'm going to look at my questions here real quick from the survey. So one question that I received was suggested stop loss. So this is again going to be a suggestive, or not a suggestive. It's going to be a personal preference based on your own risk tolerance. Okay, I've made a psychology video a couple months ago that I think it was called either risk tolerance or risk appetite. And they're pretty much the same thing. You can interchange those words. I'm going to watch that video if you haven't yet, especially if this is you who asked that question, because that's going to answer your question, I hope. But I'll also answer it now. The suggested stop loss, that all comes down to how much you want to risk. Okay, so I think the specific question regarded percent stop loss. Day trades, you want to keep your stop loss smaller. Okay, so the theory is, or the idea behind a day trade versus swing trade stop loss is you can risk more capital in a day trade because you're not holding that position overnight. So let's say, for example, you can use 20% of your account in a day trade, but you're going to put a 10% stop loss on that trade. So you're risking 10% of your account value essentially as a loss, while risking 20% of your account in a single trade. Okay, you can risk more during the session because you're not holding that risk overnight. So then you have a tighter stop loss because you have more size. Swing trading, on the other hand, you want to use less size, but then you can increase your risk, or in other words, your stop loss. Okay, so do I always use a 30% stop loss? Yes. I would say max I go is 35. Very rarely do I ever use 40 or 50. And if I use a 50% stop loss, it's because of option premium alone. And if I'm trading like a really cheap ticker, I'm trying to think like CVS, for example, used to be really cheap premium that I used to trade every now and then. I could use a 50% stop loss because their option contracts were like $100, okay, or like $1. So, if I put $500 into a trade on CVS and whatnot, okay, and the contracts cost $1 a piece, yeah, I can use a 50% stop loss because the option premium is so small. But if I'm trading something like SPY or any other large cap, yes, I like to use a large stop loss of 30 to 35%, and I do not want to go over that. That is personal preference for me. In a general rule of thumb, I have a friend who trades solely on option premium for the most part. There is a method to the madness of trading only watching option premium and price action, because option premium can be mispriced and you can make really good money if you can pick up on that and identify that. If you are on FinTwit on Twitter at all, Sam, Sam, you may or may not have heard of Sam. On Twitter, he trades using option premium a lot. And now he's a touchy subject because you either believe in him completely and you might think he's like a godlike figure, or you think he is a fraud and he is scamming everyone under the sun, charging everyone $1,000 a month. Okay. But Sam trades using option premium, and he's really good at picking up on mispriced option premium. So suggested stop loss, to get back on track, personal risk appetite. Okay, if you're comfortable risking 50% in a trade, on a specific trade, that's your stop loss. You accept that. You have to accept that. That's where the emotional aspect of a stop loss comes into play. It's really easy for someone to say, my stop loss is 25%. Okay, are you willing to risk 25% drawdown on that trade? On a $1,000 position, are you willing to lose 25% of that? Are you willing to see $1,000 of your money turn into $750 in the worst case scenario? Okay, assuming you exit right at that 25% stop loss, are you willing to accept the worst case scenario? It's really easy for people to say, I'm going to use X amount percent stop loss, and that'll be it. But when it comes time to eat that loss, that is where people get tripped up on themselves, and they don't want to accept that loss. Okay, they don't like seeing that drawdown when their stop loss is hit, and that's where your brain starts to play games on you. And you're going to say, well, I can keep holding and I'll make some of my money back. Okay, this 30% loss might turn into a 15% loss and I'll make some money back. Okay, say that happens. Say it goes back to 15% loss and moves back in your favor. Now your brain switches to, well, now it'll go back to break even for me. Now I won't lose any money. That's a dangerous game to play with yourself. Many people can say, I'm going to use a percent stop loss and I'll sell when it gets there. But when it comes time to press that sell button to eat that loss, they can't accept it. And that's because you're risking too much capital and you don't want to see that drawdown in your accounts. And you can't come to terms with that. Now, this leads me to my the second question I received regarding risk management. When to sell and take the loss. Okay, and I kind of already answered this, but I'll go into more detail here. When to sell and eat the loss, you need to have that planned ahead of time when you enter a trade. Okay, really simple for me when I trade futures. I always use limit orders. Okay, I don't like getting filled on the bid or the ask. Sometimes it means I miss out on a trade because I don't get filled, right? I mean, I showed you CL, those examples on the golden fib, okay? Those two examples, CL hit that golden fib and reversed right away, okay? Even if I have an alert set that triggers, in that few seconds it takes me to see my alert go off, to pull up my the Tradeovate screen and then press that buy button to get filled, CL has already moved away from me. I might not get filled. It is what it is. Okay, that's the downside of using limit orders. Okay, but I use limit orders because my stop loss is already in place. Okay, essentially, I don't use brackets for trading futures, but some people find brackets to be really helpful. And that might be something that you could explore as well if you trade futures, where you always have a hard stop loss set at 3 points, and then you have a win or you take profit every single time at +6. Okay, but when to sell and take the loss, why I think futures trading is far more superior is because the loss, my worst case scenario is already known because of the way that I trade and how I set up my orders. My worst case scenario is already known. Okay, I'm going to eat a 5-point loss, irregardless. That's my worst case scenario. So on one lot, that's $250. Two lots, it's 500. Okay, that is my worst case scenario. Okay, now say I get filled here like at demand or whatnot. Okay, this is my worst case scenario right here. I lose 5 points, but the upside is you want to shoot for like a 2-to-1 ratio and whatnot, whatever. You want to get filled at 10 points. That's your profit target. Okay, so it's 2-to-1. When to sell and take the loss, though, it's going to be personal, but you need to know that going into the trade. That's why I really like trading with limit orders, trading futures. Okay, and the games will be played with options. And when I say the games will be played, it's going to be in your head. Okay, it's really easy for an options trader to have a small loss turn into a big loss because of the snowball effect. And it's only because it's all in your head. You're trying to justify yourself why you shouldn't eat the loss and why you know or why you hope the trade is going to come back to you. Okay, that is a big, big, big downfall to options traders. And I can speak from personal experience there. Okay, there's been many times over my years of trading where I've let a small loss or a manageable loss turn into a big loss. Okay, and option premium, it is a funky game. Okay, options are a tricky instrument to trade for many people, and they can sometimes get screwed up because IV can inflate the option and it can start to be overpriced sometimes versus underpriced options, and your losses can compound very quickly there in that worst case as well. Options trading can be the detriment to an undisciplined trader. If you struggle with being disciplined in your trading, I would strongly urge you to give futures trading a good shot and a good try. If you struggle with discipline, okay, and locking in losses, because futures trading, you can make it to yourself where the worst case scenario going in, and that's what your loss is going to be. Yeah, it'll suck to be or to have a losing trade, but you're not blowing your whole account, right? That's the big upside here. Okay, the market will take care of hitting your stop loss, and so be it. You're out of the trade. You move on to the next opportunity. Okay, but suggested stop loss, again, to hit back to this question real quick, all about personal risk tolerance. Okay, my swing trade stop loss is 30-35%. Day trading stop loss is a good rule of thumb, 10, 15%. I really wouldn't go over 20% on a day trade because you're starting to risk a lot of premium on a day trade, right? It's the day trade. You're looking to make your money and to get out of the trade. Unless you plan on holding for hours during the session, there's really no point to risk 20% in a day trade. Okay. If you're wrong, you're wrong. There's going to be another opportunity. So now I want to dive into risk management, and I'm going to start. I say risk management. I'm going to be hitting trading psychology here as well. Okay, I can't stress this enough. The opportunity flow mindset. Mark Douglas hit freaking gold when he talks about the opportunity flow mindset. Okay, like that makes when I read that line and I started to really dwell on the opportunity flow mindset, it made a lot of sense to me, and that's when things started to click into my head. Okay, I have said repeatedly there are no guarantees in the market. Okay, and I'm a big believer in that. You cannot make guarantees. Okay, there were people who thought, myself included, after 2020, there's no way a new bull market is going to begin. The world economy is destroyed, the world shut down, blah, blah, blah. Well, guess what? A few months later, after the COVID crash lows, the market's at new all-time high. Okay, I was saying it couldn't happen. I was basically telling myself it's guaranteed there will not be another all-time high for years. Well, guess what? The market doesn't work that way. Okay. The opportunity flow mindset, in my opinion, it's the one guarantee the market does give you. It's that there will be another opportunity. You just have to be there to take advantage of it when it is presented to you. Okay. If you blow your account and you have no money to trade with, the opportunity flow mindset is dead to you. Okay. You are not able to take advantage of that anymore. And that's because you couldn't manage your risk. And I'm going to dive into that a little bit later. But first, I want to emphasize the opportunity flow mindset. There's always going to be another opportunity. Okay. But you need to be able to focus on the now moment. Okay. In the now moment, when I say the now moment, I have said that here and there in the server before. It's focusing on the market right now. Okay. If I'm dwelling on a previous old losing trade, okay, and let's say ES dips into demand right here, okay, or let's say that I'm distracted because I'm dwelling on why did I take that stupid trade and whatnot. Maybe I don't see this demand zone right here, and then ES dips into it and then reverses higher, and I don't see this until after hours when I'm making my trading plan for the next day. And I'm going to be like, well, shit, why didn't I see this in the moment? Well, the answer is really simple. You were wasting your time. You were wasting your energy dwelling on something that you cannot control anymore. Okay. If you took a stupid losing trade or an impulsive trade, as I like to call them, so be it. You are human. It will happen again. Like you're going to do it again. I promise you. You're going to make another stupid trade. You are human. You cannot expect to be perfect all the time. Okay. But you can't dwell on it. Okay. Mistakes happen. You are human. Like I want to emphasize that point too. You are human. You will make mistakes. You have to give yourself some leeway there to say it's okay. You learn from that mistake and you move on to the next opportunity. Okay. If you constantly dwell on stupid mistakes that you made, you are limiting yourself to what the market, or excuse me, you're limiting yourself into what you can see in the now moment. Okay. Does that make sense to everyone? What I'm saying about the opportunity flow mindset. And now I'm starting to talk about self-limiting beliefs, which is another big focal point of Mark Douglas's teachings. Okay. Self-limiting beliefs. He hits on that, I believe, in the Disciplined Trader, probably Trading in the Zone as well, if I had to guess. All right. But to keep talking about the opportunity flow mindset, don't waste your time and don't waste your energy on things that you cannot control anymore, like an old losing trade that you maybe took a couple hours ago earlier on in the day. You cannot do anything about it. Why are you still wasting your time? For all you know, the market is telling you you have an opportunity right now to make money based on your system and your edge, but you're too busy kicking yourself and you can't take advantage of it. Okay. That is like we're starting to get and build ourselves into a mental rut when we start to do that. And that can have some detrimental long-term negative impacts on our mental edge as a trader. Oh, absolutely. Yeah, it's definitely okay to punch a hole in the wall. Absolutely. Absolutely. We've all been there. Um, So again, talking about the opportunity flow mindset. So in my opinion, then there's always going to be another opportunity. That's the one guarantee the market brings, right? However, I want to, that's a very general and broad statement that I'm going to say. Now I want to wind it down a little bit for you. Okay. Your system and how you trade will tell you when there is an opportunity for you in the market. Okay. When your system says there's an opportunity for you, that gives you an edge in the market. Okay. The opportunities will come and go. Okay. Obviously, right now, as I started the beginning of this workshop meeting, I said I don't see any good swing low to swing high to use for drawing the long golden pocket on ES today. Right. And I said how I didn't like this. I thought it was a poor low. Okay. And then I went and showed you Wednesday's session and how ES bottomed at the 50% Fib level. Okay. That's a decent opportunity. No, I didn't take it because it was FOMC day and for other reasons, right? Surge in volume and all that good stuff. Okay, but that was a better opportunity the market provided yesterday. So far, ES has not provided a good retracement into a key fib level for me. Okay, and that's fine. What market did? Oil provided an opportunity for me. Okay, oil provided a move into the golden pocket, and I was able to capitalize on that instead. Okay, I am not limited to trading one market. Okay, some people who trade futures, they only trade one market. Like they'll limit. There's a lot of people who only trade NQ. Okay, there's a lot of people who only trade oil. That's fine and all, but you're limiting yourself. Okay, if that's your one specialty and that's the market that that's fantastic. You trade to your strengths. Okay, for options traders, there's a lot of people who only trade SPX. There's a shit ton of people who only trade Tesla. Okay, I mean that's like the cult stock in the options traders world on a little bit. Okay, that's fine. If that is your strength as a trader, you can trade those specific markets. Okay, but I'm a little bit more flexible. I can trade ES and I can trade oil. So if I don't see any opportunity in ES, well, am I going to waste my time watching ES the whole time? No, I'm going to go look for the next opportunity. And that's when I was able to see, oil is selling off into the golden pocket. I now have a high probability edge in the market based on my system. My system is telling me I have an edge here. I'm going to go long at the golden pocket or at the golden fib. Okay. And then I'm able to catch that reversal higher. Okay. You have to be a little proactive in the opportunity flow mindset, but use your system to your advantage. Okay. And I'm going to now move into the irrational environment that the market is. I'm going to still tie this all in at the end. Okay. So the market, this is one big irrational environment. You cannot make sense of it, or you can try and make sense of it. And it might make sense to you being an irrational environment, but more often than not, people will try to bend the market to their will, and you simply can't do that. Okay. Unless you happen to work for Ken Griffin. Okay. You're not going to bend the market to your will. Instead, you have to learn to sit patiently and be disciplined until your system, again, I'm going to say that your system tells you you have an edge in the market. Okay. When your system tells you you have an edge, that is when you capitalize. Okay. If you don't have an edge in the market, why are you placing a trade? You're giving in. That's like an impulsive losing trade. And I struggle with those sometimes where I'm going to say, you know what? I think I can do something here. I think my edge isn't present, but I have like an intuitive feeling. Like I like to tell myself that. And I basically try to justify to myself, this is going to work out well. Well, guess what? It doesn't ever work out well. Okay. Impulsive trades tend to be losers. Okay. Like right here, I have no edge. If I tried to trade this breakout right here at the highs, where am I? Right here. Okay. I mean, yeah, can it work? Absolutely. But a breakout trading is not my style. Okay. 50% of the time, breakouts fail anyways. Okay. Yeah, there's decent volume and whatnot. But now I'm trying to justify myself why I am not trading my system and why I'm taking a low probability trade. Okay. We're breaking out of this range. Is it a high probability breakout when we're already up 1.5% on the day? Probably not. Can the market keep rallying higher? Absolutely. It always can. Is it high probability? No, not in my opinion. So why am I going to do that? Because I'm lacking discipline, because I'm giving in to my worst impulsive emotions. Okay. that is the trap that traders can fall into. And when you look at that, we're starting to see sellers come in on a false breakout. Kind of funny how that works. Let me see this question. How do we go about trading false breakouts? Seems like that happens a lot. It happens a lot because it absolutely does. Okay, breakout trading. Very good question. Breakouts fail 50% of the time. At a minimum, breakouts fail 50% of the time. Okay, if a breakout comes on low volume, they're going to fail up to 75% of the time, if not even more. Okay, you want there to be volume on a breakout. And if you're going to see my upcoming weekly plan when I go over SPY on this reversal, depending on how this weekly candle closes based on Apple earnings, there's a very, very high possibility, if you look at SPY weekly based on the volume, the swing low is in and we're kicking off wave 5 now back towards 440, 450, 460. Okay. Low, you need to look at volume if you're going to trade breakouts. Okay. And then you want to wait for candle close. Those are the two big keys for trading breakouts. I used to do it. I don't do it anymore because I've lost a lot of money doing it. And now my style has reverted to reversal trading. Okay. Understand if you're trading a breakout, you're putting yourself at a little bit of a disadvantage. Okay. So if we look at ES right here, and we're going to draw up, is this long position? Yeah, it is. Okay. So if we're looking at ES right here, say you want to put your stop loss down here at the low of this range. Okay, that's 9 points. You're risking almost $500. You're risking $450 on one lot. Okay. To make it a 2-to-1 reward ratio, you now want to shoot for 18 points. Okay, that's another 0.5% move when the market is already up 1.5%. Okay, so can this market rally over 80 points on the session? Yes, it absolutely can. However, does it make sense when you incorporate ATR into what you're into this trade? Okay, does it make sense to go long on a breakout of high a day when we're already up 67 points and ATR? I'd say right now, I haven't looked at it in probably a month. I'd say ATR right now is about 50 points for ES, 50, 55 maybe. Either way, we've exceeded ATR for the day. So never a good opportunity or never a good high probability setup to go long. Okay, if you do want to trade a breakout, that's fine. I would recommend in or lower size. Okay, reversals like into the golden pocket. Yeah, you can put your you can increase your size because it's a reversal trade. It's going to give you much more favorable risk versus reward. A breakout trade, if you trade it, that's fine. I would just say lower your risk. For volume, would it be the size of the candle or the amount of sales that shows a number? For example, it might say 1 million. I would say I look at the volume bars. Okay, so I don't look at what volume itself is saying. So like right now, the volume is at 16,500 lots. 16,500, like that's a lot, but at the same time, it isn't. Like right here at the open, we're probably looking at over 100, maybe 200,000 lots right here. So I would say I would look at the volume bar, not necessarily what the number specifically is. If you see an expansion in volume with an expansion in price, so volume, the increase in volume matches the increase in the candle, yes, that's a good high probability setup because money, essentially smart money and traders are interested in the move. They're active in the move. Okay, that is how I would word it. Okay, so as long as you keep seeing an expansion in volume matching the expansion in price, and then obviously vice versa, if for a sell-off, that's a good indication that, hey, there's legs behind this breakout. Can it still fail? Absolutely, because you don't know what comes next. And you need to know that ahead of time when you enter that trade, or not know it necessarily, but you need to accept that fact that, hey, this can reverse on me still. And you can't tell yourself, well, this breakout's going to work. You can't basically guarantee to yourself that this breakout's going to occur, because then you're inflicting mental damage on yourself when it fails and you have to eat that loss. Does that make sense? And then, okay, so kicking it back to the irrational environment. All right, so again, I'm going to be talking about from a futures trader's perspective, but this still applies to options traders. Okay, I'm just going to use the language I'm using and the examples I'm using it's going to be futures. Okay. So each tick in ES, okay, each 25-cent tick right there, you see how it just changed from 25 to 50, and then it'll change again here in a second from 50 to 75. Okay. Each tick in ES is $12.50 profit or loss. Okay. Earlier in this meeting, I said for each tick in CL, each tick, which is 1 penny, don't forget that it's 1 penny. Each tick or every 1 cent move in CL is $10 profit or loss. Okay. So with each tick in ES, you have the opportunity to make $12.50. 1 point is worth $50. So for every 1 point, you essentially have the opportunity to make $50 profit or loss. Now, when we look at the market, it's an irrational environment, and you have to make sense, and you have to give yourself structure to some degree in this irrational environment. And that's how you're going to survive as a trader. And when you give yourself structure, that means you have a system in place for how you trade. Okay, that is what's going to keep you in this game in the long term, is if you have a way to trade and if you have a way to make sense of this irrational environment. Now, my way of making sense is a reversal trader. Okay, I want to trade the bounces at demand at the long golden pocket, or the sell-offs from a rally into supply, or a sell-off, or excuse me, a rally into the short golden pocket. Okay, that is how I make sense of this irrational environment. How you trade and what your system is, that's how you make sense and give yourself structure in this irrational environment. So the undisciplined trader who does not have a system in place and thus lacks structure is going to look at each tick as an opportunity to essentially win the lottery. Okay, that's what it's going to be. So $1 move in CL, if you haven't done the math yet, a $1 move in CL, and now granted CL moves, I'd say $1 to $2 every day. A $1 move in CL is $1,000. Okay, so if I don't know oil's ATR, I'd imagine it's between $1 and $2 right now. Now that we're back north of $50, so if you have the opportunity to make $1,000 in a single day trading one instrument, which is oil, one tick is going to represent essentially the best casino that you've ever seen if you lack discipline and if you don't have any structure in place. Okay, keep in mind with that example I showed you earlier in CL with the first golden pocket, okay, we saw it rally to like $600 max profit and then it reversed lower. If someone does not have structure in their system, or if they don't have a way of, if they don't know how to lock in profits and to raise stops as the market moves in their favor, they're going to look at that $600 and they're going to say, oh, I can make 700, I can make 800, this can get me to 1,000. Okay, that's to their eventual detriment and downfall as a trader. Okay, because they lack that structure in place to tell them, hey, this is a good way, this is a good place to trim, this is a good place to lock in full profits and whatnot and move on to the next opportunity. Okay, people who don't have structure, they're going to look at each tick in this market as an opportunity to essentially hit the jackpot. And they're going to tell themselves, wow, I can make so much money doing this. This is so easy. Okay, well, it's not that easy. It's going to be really hard for this to do that consistently. Okay, you can hit it big one time. You might be able to hit that jackpot in oil where oil explodes $5 in one day or sells off $3 in another. Okay, you can hit that jackpot one time. Can you do it the next day? Can you do it the next week? Can you do it the next month? The answer is no, you can't do it. Okay, you can hit the jackpot one time and that's it. Okay, eventually, if you don't have structure in place as a trader in this big irrational environment that is the market, you're going to fail. So you have to have a system in place that tells you when you have an edge, when you have an edge to make money, when you have an edge to place risk in this market. Okay, when you have that system in place, that's going to keep you from making those stupid impulsive trades that you are going to kick yourself in or for after you eat that loss. And you're going to tell yourself, why did I freaking do that? Okay, I knew I shouldn't have done that. It was so obvious this was going to be a loss, but then you did it anyways. Okay. When you have a system in place that tells you when you have an edge, it's going to be a lot easier on you to not give in to those impulsive trades. Okay. And you're still going to give into them every now and then. Okay. You're human. It's going to happen. It is what it is. Okay. But when you have that system in place, it helps act as a big safeguard from making the worst decisions as a trader. Do I hedge my trades? No, I do not. I do not hedge my trades. I used to hedge. I used to make hedging a big part of my system in 2020. Like once I got over my bullshit of being like a biased, I was the biggest bear in 2020. Like April through May, I took a significant drawdown because I kept trying to short the market. Um, in 2020, I would use hedges. In my opinion, ever since this bear market started and ended, and I say ended because it's over by technicality wise, the bear market's over. It is what it is. Um, I would say hedges are going to be harder right now because of an elevated VIX. So, VIX right now, it's crushed today down 4.5%. When you have an elevated VIX like this at 18, $20, your hedges are going to be really expensive. Now, of course, the option premium is going to be expensive on like SPY and whatnot, but it comes down to, is the hedge worth it if you're depending on how much money you're risking. So no, I don't personally hedge. Depending on your trading style, hedging might not be worth it at all. You just have to risk less capital in each trade. And that's just a personal decision you have to make. So that's what I've done. Okay. I don't hedge with VIX anymore. Right. Especially, now that if again, we're going back in time here, 2022, there was like a 2-month buildup to Russia's invasion of Ukraine. Right. And it was like every night futures would make wild moves. And then on February 24th, what was it, 2022, right? When Russia finally invades Ukraine, the market catches a massive bid because the event finally happened, right? And there's no more buildup to it. There's no more suspense. The market knows it's happened now. Okay. So then we saw a big crush in volatility. And then through that whole first few months of the Russian invasion of Ukraine, you have these big upswings and downswings overnight and in the equity markets and specifically oil and then commodities too. It makes it harder to hedge overnight because of those big upswings and downswings. Your hedge can be blown out from a simple volatility crush, but then your primary position can also take a big hit again because of a volatility crush, thanks to the VIX and IV on the options. So do I hedge my trades? No, I just use less size. And again, what were we talking about just a few minutes ago right here? Breakouts like to fail. If they waited until like the last 2 minutes on this 15-minute candle that was up here like a few minutes ago, and then the last 2 minutes, it closes back inside this range. So really nice false breakout right there after seeing a brief new high a day. Now, price is still above the point of control, blah, blah, blah. But that's extra stuff. Really good example of a false breakout and breakouts failing. And notice the increase in volume too on that false breakout. So to get back on track with the irrational environment, self-discipline is when you only trade your system that tells you you have an edge in the market. Again, the market being the irrational environment, and your system is going to tell you that you have an edge now in the now moment. Remember, opportunity flow mindset. You need to be focused on the now moment to take advantage of those opportunities when they come. Okay. So your system is going to tell you when you have an edge in the now moment in this big irrational environment, which is the market. And that is how you make money. Okay. So if that doesn't make sense, please let me know in the chat box so I can explain it further. But I really want to hit that home. Okay. So there's always going to be another opportunity, but you have to be focused on the now moment in the market for when your system tells you you have an edge, because it can come whenever, like it can honestly come whenever. Okay. I mean, for all we know, we can get a really nice sell-off right here over the next hour. And then at 2 p.m., SPY is working its way back up, or ES. And, we can draw the short golden pocket, whatnot. We get a reversal at 2 p.m. At 2:30, it hits the short golden pocket, and then we're positioned short into close. You never know when this is going to happen. So you need to be prepared for when the market tells you you have an opportunity. How do you stay prepared? Focusing on the now moment. constantly looking for new opportunities, but don't force them on yourself. Okay. And then last but not least, to finish this Zoom meeting up, we're over the 1 hour mark. So this is pretty much where I want to end with. Trading is the long game. So a big detriment that I found I would say a few years ago, I would say in 2020. So like after I got over my bullshit of being a biased bear, I found some really nice consistency again as a trader. And then I ran into my next downfall or self detriment that I would constantly trip myself over. And it took me about 6 months to get over this. Trading is the long game. Okay. So you can go on a really nice win streak as a trader. You can see these really big wins. You can see these really nice long winning streaks. Okay. Well, that eventually gets to you. You're going to start getting high on yourself. You're going to start building up that ego as a trader. And that all leads to euphoria. Okay, now some people deal with euphoria and it's a big problem for them. And I've seen other people be very successful, have very large winning days, have very long win streaks, and euphoria doesn't affect them at all. So I think a lot of people struggle with greed and fear. I think that's pretty universal. I think euphoria is a bit different. I would say maybe half of every trader out there struggles with euphoria. And I was one of them, but you might not struggle with euphoria, and that's okay. But for my people that struggle with euphoria, when you hit that euphoric moment, it's going to lead to bad risk management. And this is what happened to me. I started getting really high on myself after a really nice winning streak and I ended up giving back like half the money I made within a few days. Okay. It's really easy to do that when you get high on yourself and high on your abilities as a trader. Okay. You have the ability inside of you to be the best trader that you've ever known. You have that is an unlimited ability each and every one of us have. We have the ability to make a shit ton of money as a trader. I myself possess it and you yourself possess it. Okay. Each and every single one of us can become an incredible trader, but you cannot become euphoric and high on yourself because that's going to lead to poor risk management. Okay. So you need to look at trading as the long game. And this is my best fix so far for euphoria is I look at trading as the long game. Okay. You need to take it one day at a time while also telling yourself this is like a lifelong career essentially that you're trying to make as a trader, right? Because the markets aren't going anywhere. If the markets leave, society in general is probably leaving as well. Okay. The markets aren't going anywhere. So take it trading one day at a time. Do not get caught up in the euphoria of a large win in a single day or a large win streak. Okay. You need to take it day by day and you need to tell yourself, I need to be here next week. I need to be here next month. I want to be here next year as a trader. Okay. When you tell yourself that every single day, you're going to start taking it day by day by day. You're going to look at what the market gives you in the now moment every single day, and you're not going to worry about what happens tomorrow, what the market's going to do tomorrow. Okay. And specifically for events, people who are more often than not, they lack consistency and they are not a profitable trader. They're focused on events. They're focused on what the market's going to do tomorrow, what the market's going to do for FOMC next month. Okay. Does that matter as far as making money right now? No, it does not. Not at all. It doesn't matter for making money tomorrow. What happens in December FOMC? Okay. That's what unprofitable traders do. Okay. You want to focus now. You want to focus on what the market is giving you right now to make money. And that's fine if there's no edge right now, but you keep an eye and you're ready for the market to give you an opportunity by focusing on the now moment. Okay. Euphoric traders start to get ahead of themselves. They're going to start looking into the future and thinking, wow, I can't wait to buy this brand new truck. I can't wait to buy, or I can't wait to go to Disney or Vegas or whatever on a free vacation because of all this money that I made. Okay. When you start thinking like that, that's a nice goal for you to have. And that's a nice goal for you to work towards. But when you start telling yourself, wow, I'm going to make all this money as a trader because of what I did today, and you start to lose sight of that long game, you're going to trip yourself up with very soon in the not so distant future. And you're going to see all that money go poof that you made, and it's no longer yours. You gave it back to the market. Okay. For my long-term members, if you remember that massive win that we hit off of Facebook earnings, like back in 2022, I was not expecting that. Okay. Like what was that? Like a $70, $80 drop in Facebook, made a shit ton of money. I took all of that money out. I was not expecting that. I was not giving that money back to the market. Every single dollar profit I made off of that trade, I took it out of my account and I paid myself right away. I was not giving myself a chance to be euphoric and to piss that money away into the market. The very next day, when that money settled, I took it all out of my brokerage account. I was not giving that money back to the market because I couldn't believe it. That was like the best earnings trade I've ever done. And I've had a few good ones, but that was by far the best. Okay. So I wasn't giving myself a second to be euphoric and to get high on myself and that win that I took. Okay. And yeah, I mean, it happens. And then winning streaks are going to come and go. Okay. Like it's nice to try and give yourself like a green streak or to work towards a winning streak. Like that's something that you can do. Okay. But you can't tell yourself, I'm going to extend my winning streak today. Okay. No, you need to tell yourself, I'm going to execute my system when I have an edge in the market. I'm going to take those A plus trades. That's what you tell yourself. And when you put yourself in enough A plus opportunities, based on how you trade, which is your system, you're going to consistently make money. Okay. Just because you take 3 losing trades in a row based on your system, does that mean your system's a bust? Absolutely not. Okay. I can take, like, look at Boeing, for example. Boeing, that's a textbook bearish reversal candle into the golden pocket, rejecting the golden fib, and it's a loss. Does that mean I'm done trading with the golden pocket? No, not at all. Okay. You can go back in time and see how many hundreds of golden pockets have worked out. And then you can see probably hundreds of golden pockets that have failed. Okay. Each trade, each setup is its own trade. It has its own, it's built on its own merit. And it does not mean one loss does not invalidate a system. Okay. Any chance of recovery on BA? No. No. Dow Jones is up over 400 points right now. No. Boeing is weighted in the Dow Jones. So I don't even have to look at SPY or NQ. I just look at Dow Jones. Dow Jones up 400 points. Boeing's going. Okay. But just because Boeing's lost does not mean that the golden pocket is pointless and it's a busted way to trade. Not at all. Okay. So that is all that I wanted to go over for this Zoom meeting and this workshop. If anyone has any more questions for me, please drop them in the chat below. Other than that, that is all I had to go over for today. So I hit Fibonacci. And I know some people joined throughout the meeting. So Fibonacci is in the first half. Second half of the meeting is risk management and trading psychology. And don't worry, meeting is recorded, so I'll get that uploaded to YouTube tonight, and I'll probably share the link sometime tomorrow. Absolutely, absolutely. I'm happy you were able to join. I hope I was able to help out in some way. Thank you for joining. Alrighty, if there are no questions, I'm going to go ahead and end this meeting here. I hope everyone has a great rest of your Thursday. Make sure to manage your risk, and let's have a nice, strong, or nice finish to the day, and let's have a great Friday tomorrow.